So we've got two choices, pretty much fundamental choices. We follow the gap or we fade the gap. So what are the criteria that we're going to look at that are going to make us choose what we want to do? Now, the size of the gap, we don't go into too much depth here. There's actually loads of resources out there that have back tested this kind of thing in relation to how big the gap is, whether you get further movements and this kind of stuff. But generally speaking, in a broad sense, the bigger the gap, the more likely you're going to get some continuation. Now, I say that very broadly because obviously that's a very sweeping statement. But ultimately speaking, when you have a gap of a significant size, something has happened to reprice that market, to make traders believe that the value has changed on it. And so, a lot of the time you're going to get some sort of continuation. You may later in the day get a reversal, especially if you're in a bull market scenario, which is obviously quite common in a bull market. You get later on people coming in and buying it because obviously it's a bullish underall sentiment with a trend. We'll talk about trends in another video. But that's tend to be what happens. So what do we look for on the open or on the close? So I'm going to bring this chart up now in 1 minute, and actually this is something that I got involved in, and it's refreshing my mind, so let's talk about it right now. The thesis you've kind of got is we've got a big gap. We understand that it's over a really decent amount of days and it's quite big for the day. Dow was down 200 and something points. It doesn't matter at all what the news is. I'm not going to go into the news. It is almost irrelevant because you kind of just want to trade the pure price action. So let's assume now we want to trade with the direction of the gap. For whatever reason, we've decided that's great. We're looking for shorts. There are generally a couple of things that can happen. You get the opening print, you get a drive lower, you get the opening print, and you get a drift higher. That's pretty much it. Okay, sometimes you do get where it just sits there and does nothing, and that sometimes happens for stocks that have had key things. But let's forget about that, because if we identify that, we don't want to get involved in it anyway, and we perhaps want to bracket it with alerts and get involved at a later date. So let's just look at these two scenarios here. Scenario number 1 here and scenario number 2 here. Now, to get involved in scenario number 1, the number one thing we don't want to do is start chasing lows, a gap lower, chasing lows, because generally the reason this is pushing lower and getting more aggressive to the downside is that people are caught in it. They're caught long, they're closing the positions, whatever it may be, or we got longs unwinding. It's people who are less sensitive to price who are hammering that bid. There's not many buyers stepping up and causing that drive to the downside. So we don't really want to get involved in extreme scenarios as traders. We want to identify extreme scenarios, wait for the unwinding of the spring, and then get involved. So let's look at that a little bit closer. Let me clear out some of this drawing and come back on. Okay, so we've seen the drive lower. What do? The idea is we want to get involved on a pullback. Now, with a gap, you've got to be very careful that you don't get involved in a V-shaped reversal, especially if the market's in a bull market. I don't want to go through every single permutation because you've got your own style out there. You're going to know what works for you, and this kind of just guides you and gives you maybe a little bit more of an overview of how someone else trades gaps, and you can look at it, take it or leave it as you see fit. And what I kind of do with traders is pick the little bits that I like and form it into my own kind of strategy, and then over the decades it kind of adds up into a good setup or library of setups that you can use yourself. So you don't want to be very careful you're not involved in this V-shaped reversal, because if you are, then you're obviously going to be selling lows, or you're going to be selling here and it's going to snap back and viciously get you, which is quite often happen with gaps. So you've got to be a little bit cautious. But if you're identifying a gap low and you've decided you want to take a continuation trade, and it drives immediately off the low, you're looking for that pullback to get short on. Now, I've talked a little bit about getting involved in pullbacks before. Generally speaking, you want to try and wait and see how strong that pullback is. So if you measure this kind of move roughly, you don't have to be there, being very accurate with it, but you can use like a fib tool that you've amended, or just something to quantify this amount. So you could say, hey, this drive from open to low was 50 ticks on the Dow, on the DAX, on the FTSE, whatever it may be, on a stock that you're trading. Doesn't matter. Let me see how far this pullback comes up. How long does it take? Let's look at the time period it takes. The longer it takes to claw back, let's say it's clawing back just 10 ticks and struggling here, then you kind of know that, listen, supply demand is out of sync. There's a lot of supply coming in. We've got a little bit of demand that's causing the price to push up. However, it's stalling here. We've recognized it's stalling, it's struggling, it's starting to roll over, or it's just not pushing higher. It's very slowly pushing higher. Now, if you think of that in a perspective of price action and the kind of auction theory of the market, without going really down this rabbit hole, you're advertising for buyers at a really distinct discount to what it was yesterday. If this was yesterday's close up here, you've got a gap lower and you've got a 50-point drive lower. That's a serious discount. And if you still are not getting a lot of buyers in, then perhaps there's still an overhang of supply. So if you see that, if you see it drive up, if you see it stall, perhaps you're going to see this scenario, a tiny little kind of congestion pattern at the top of this. Again, I'm a little bit scruffy with this drawing pen, but I guess you can work this out. A fake out to the high that then rolls over. That's the kind of thing we can really drill it down and finite that risk. But ultimately what you're looking for is phase 1, the drive lower, strength and drive lower. Phase 2, the pullback. I mean, if it pulls back and keeps going, then you're going to have to scrap that idea, because if this thing starts to go up into the upper half of that drive move, let's say it's the first half, that's the second, you really don't want to get involved in it, because that's telling you that things aren't that skewed to the supply level and we could be in for a full reversal, and you might want to look at some other scenarios with that. But if you do see the fact that the price is driven lower, you do see it's aggressive, you do see a big gap, you do see it pushing up and stalling, then a little short trade for another drive lower isn't out of the question. And that's the kind of thing that I would be looking for personally. I would also be aware that I'm not looking for a mega monster day. They do come out of somewhere, and actually days when you have gaps, you do get those mega monster trend days, so you can throw your kind of ATRs out the window and true ranges, so you can look for that. But what I'm looking for is the high probability meat of the trade. It's that drive, I've seen it, it's the pullback that struggled to make any progress into that trend and definitely hasn't broken the 50% mark of the drive. Struggled. Maybe it's been about 15 minutes. That's a little bit of a rule of thumb that I like. If you've had a 15-minute move, you're going to get another wave to the downside if it hasn't reversed by that time. Generally, again, a very broad kind of rough guide there, but often that happens very often is you get the first 15 minutes and then another wave of selling comes in. So if that's on your sort of 15 minutes, your 2:45 time period, then that's perfect. UK time, so it opens at 2:30, 2:45, 50 minutes trade. Look for the next leg. So that's one way of looking at it. Let's look at another way of looking at these, trading these continuation gaps in the next video.